let's actually take a look at the reality. Fannie and Freddie weren't the only entities in Washington pushing for looser lending requirements. Government agencies of various kinds were pressuring lenders into making riskier loans in the name of racial equality. Not wanting to be on the wrong end of lawsuits demanding hundreds of billions of dollars in damages, these lenders did as they were told. Charges of racial discrimination in lending helped spur the rush. In 1992, a study by the Federal Reserve Bank of Boston claimed to find evidence that even allowing for differences in creditworthiness, minority applicants were still getting mortgage loans at lower rates than whites. That study was widely hailed as definitive by those who wanted to believe its conclusions, that American banks were guilty of discrimination against blacks and Hispanics, though not against Asians who got mortgage loans at even higher rates than whites, and should be forced to make credit more widely available to people in inner-city neighborhoods. Evidence later surfaced exposing the sloppiness of the study and showing that no evidence of discrimination was found when errors in the data were corrected. But it was too late. The pressure groups had their bludgeon and intended to use it. Let's see this bludgeon in action. The Hidden Clue by Peter Brimlow on January 5th, 2005 at 2 a.m. First published in Forbes, January 4th, 1993. Media hoopla to the contrary, the evidence suggests that banks are colorblind when it comes to mortgage lending. Definitive changes the landscape, Office of the Comptroller of the Currency. Comport with common sense, no more studies needed. Richard F. Siren, President, Federal Reserve Bank of Boston. These ecstatic press notices greeted the Boston Fed's recent study claiming to prove racial bias in mortgage lending, the social problem of the season, with coverage in the Wall Street Journal, 5 stories in 8 weeks, regulatory rumbles from the Federal Reserve, legislative leers from Congress. The pressure is on mortgage lenders to change credit standards for minorities. But the study's analysis makes an elementary error about a crucial question, minority default rates. Queried by Forbes, Alicia H. Munell, Boston Fed Senior Vice President and Research Director, conceded that the study's handling of default rates was definitely not an adequate look at all. Minority mortgage applicants do tend to be rejected more than whites. A Federal Reserve Board survey of 6.6 million home mortgage applicants in 1991 showed that 37.6% of black applicants and 26.6% of Hispanics were denied home loans, compared with only 17.3% of whites. This finding held across all income levels. But what's the difference the result of racism, or of an objective, colorblind application of sound credit standards? The data on default suggests the latter is true. Mortgage lenders consider a range of worth, age, education, probability of unemployment, and credit history. Minorities frequently far worse by such measures. Perhaps that's because society gives them fewer opportunities, but mortgage lenders would still be objective, not prejudiced in rejecting them. The Boston Fed study did where are we here? The Boston Fed study did correct for standard credit criteria based on a sample of Boston area mortgage applications. It found that these criteria did explain about 2/3 of the difference between white and black Hispanic rejection rates. Interesting. But even after this correction, minorities seem to be rejected at a rate of 17% as opposed to only 11% for whites. This difference, the Boston Fed claimed, must be caused by racism. Mortgage Lending in Boston, Interpreting HTMA Data, Working Paper 92, Tax 7, link below. Oh yeah? But what about those default rates? We are aware of what people say, oh, this may be rational discrimination because minorities default more, the Boston Fed's Munell told Forbes, but her study sample was too recent to check default rates directly. Instead, the Boston Fed compared default rates across census tracts. And what we found was there was no relationship between the racial composition of the tract and the default rate. So it wasn't true that tracts with large minority populations had higher default rates. Think about this carefully. The Boston Fed authors apparently assumed that equal default rates meant all minority applications are an equal credit risk compared with whites. But they're wrong. These census tract mortgages had already passed through the loan approval processes, which had presumably rejected a higher proportion of minority applicants on the way. So the fact that white and minority default rates finished up equal meant mortgage lenders knew what they were doing. The market, in short, worked. The mortgage lenders somehow weeded out the extra credit risks among minorities down to the point where white and minority defaults were at an equal, apparently acceptable rate. That is a sophisticated point, says Munell, questioned by Forbes. She agrees that discrimination against blacks should show up in lower, not equal default rates. Discrimination would mean that good black applicants are being unfairly rejected. You need that as a confirming piece of evidence, and we don't have it. So then Forbes asked, did you ever asked the question that if defaults appear to be more or less the same among blacks and whites, that points to mortgage lenders making rational decisions? Munell responded with, no. Manel does not want to repudiate her study. She tells Forbes on reflection that the census data are not good enough and could be massaged further. I do believe that discrimination occurs. Forbes asked, "You have no evidence?" Manel responded, "I do not have evidence. No one has evidence. But if there is racial discrimination... But if there's racial discrimination in lending, it means that mortgage lenders forego profitable businesses because they are prejudiced. That's unlikely on the face of it, and becomes more unlikely when one notices that Asian American applicants are actually turned down less often, 15% in the Fed survey, than whites. However, logically, it could be precisely those institutions marketing most vigorously to minorities that generate the most marginal applications, and therefore the highest rejection rates. The Boston Fed study itself noted that denied minority applications on average had poor objective qualifications, suggesting a systematic bias in mortgage lending is very difficult to document. But in today's climate, any statistical disparity is viewed as discrimination and an excuse for more social engineering. This kind of thinking may be good enough for government work, college admissions or civil service promotions, but you can't expect banks to act that way. They're using their own money and must lend to people who can pay it back. Ralph Bostek wrote The Role of Race in Mortgage Lending, revisiting the Boston Fed study in 1997, which he said, "Thus the claim that non-economic discrimination is a general phenomenon is refuted. Further, I can say little regarding the existence of discrimination among marginal applications. To conclude that such discrimination exists, one must prove that the observed differences are not due to economic factors." Who were one of these young and bright upcoming lawyers who made these false accusations of bias and racial discrimination that caused lowered lending standards? Because they did happen. These lawsuits did occur and they did pressure the banks. Who were these lawyers and what was the name of some of the cases? Well, Buckeyes Robertson versus Citibank Fed, Saving Banks Fair Housing Lending Insurance, docket/court 94C 4094. Case summary: plaintiffs filed their class action lawsuit on July 6, 1994, alleging that Citibank had engaged in redlining practices in Chicago metropolitan area in violation of the Equal Credit Opportunity Act. Plaintiffs alleged that the defendant bank rejected loan applications of minority applications while approving loan applications filed by white applicants with similar financial characteristics and credit histories. Plaintiffs sought injunctive relief, actual damages, and punitive damages. Let's take a look at some of the lawyers who actually filed this. Alexis Hillary, Michael Allen, Clayton Fay, Cummings Jeffrey, Love Sarah Norris, Minor Justin Hertz from Illinois, Obama, Barack H. Illinois, FH TAC IL TAC 0011 TAC 7500.
Aggressively to take a greater risk on these mortgages, yes. To give families mortgages who they would not have given otherwise, yes.
The loans at all.
They would not have qualified but for this affirmative action on the part of the bank, yes.
Minorities are represented in that low and moderate income group?
It is by income and is it also by minorities, yes.